Listen carefully to what I'm about to tell you. Just yesterday, on January 6, 2025, Bank of America, one of the largest financial institutions in the world, issued a research note that sent shockwaves through the precious metals market. Their senior commodity strategist, Michael Widmer, put a number on silver that most analysts wouldn't dare whisper out loud: $309 per ounce. Let me put that in perspective. Right now, as markets open today, silver is trading around $32 per ounce. Bank of America just told the world that silver could increase by nearly 900%. Now, I know what you're thinking. This sounds like clickbait. This sounds like another precious metals hype video. But here's what makes this different. This isn't coming from a gold bug YouTube channel or a coin dealer trying to move inventory. This is coming from Bank of America, the same bank that manages $2.5 trillion in assets. The same institution that advises central banks, sovereign wealth funds, and the largest investment firms on the planet. When they put a number like $309 on silver, people inside the financial system pay attention. But here's what's really important. Why they're saying this right now, what it means for the broader financial system as we enter 2025, and when they believe this could happen. Because the clock is already ticking. Let me show you the mathematical foundation of this forecast, because this isn't speculation. It's based on one of the oldest pricing relationships in financial markets. It's called the gold-to-silver ratio. Here's how it works. Right now, gold is trading at approximately $2,900 per ounce. Silver is at $32. If you divide gold by silver, you get a ratio of roughly 90-to-1. That means it takes 90 ounces of silver to equal the value of 1 ounce of gold. Gold, $2,900. Silver, $32. Ratio, 90-to-1. Now here's where it gets critical. That 90-to-1 ratio is historically extreme. For most of the past century, the gold-silver ratio has averaged between 50-to-1 and 60-to-1. During precious metals bull markets, it compresses dramatically, meaning silver outperforms gold by a massive margin. Let me give you the historical data. In 1980, during the last great precious metals mania, the ratio hit 14-to-1. Silver was trading at record highs while gold was also surging. In 2011, during the post-financial crisis commodity boom, the ratio compressed to 32-to-1. Silver hit $49 per ounce while gold was around $1,900. In 1991, the ratio was at 100-to-1. And what happened next? Silver doubled within 18 months while gold barely moved. Bank of America's Michael Widmer is looking at this pattern and making a straightforward calculation. He's saying, if history repeats, and it always does in commodity markets, we're looking at a massive reversion to the mean. Let's do the math together. Scenario 1, the 2011 model. Current gold forecast for 2026 is $4,538. That's Bank of America's projection. Historical 2011 ratio was 32-to-1. Silver price would be $4,538 divided by 32, which equals $141 per ounce. Scenario 2, the 1980 model. Current gold forecast is $4,538. Historical 1980 ratio was 14-to-1. Silver price would be $4,538 divided by 14, which equals $324 per ounce. Bank of America is using $309 as their upper target, which corresponds to roughly a 15-to-1 ratio. This isn't a wild guess. This is mathematical modeling based on documented historical precedent. But here's the question that should be burning in your mind right now. Why would the ratio compress at all? Because something fundamental is changing in the silver market, and Bank of America sees it coming. Silver is not like gold. And that's the key to understanding why this forecast isn't just possible, it's probable. Gold is primarily a monetary metal. Yes, it has industrial uses, but roughly 50% of gold demand comes from investment in jewelry, stores of value. When you buy gold, you're buying a hedge against currency debasement, political instability, financial system risk. Silver is different. 56% of silver demand is industrial. Let me walk you through where silver is actually going. Electronics. Every smartphone, laptop, and television contains silver. It's the most conductive metal on Earth. There is no substitute for silver in high-precision electronics. Solar panels. This is the big one. Each solar panel requires approximately 20 grams of silver. Global solar installations are exploding. China alone is installing more solar capacity than the entire world combined just 5 years ago. Medical applications. Silver is antimicrobial. It's used in wound dressings, medical devices, water purification systems. Hospitals around the world depend on silver compounds. Automotive. Electric vehicles use significantly more silver than traditional combustion engines. Every EV charging station, every power inverter, every high-efficiency motor, they all require silver. 5G infrastructure. The build-out of 5G networks requires massive amounts of silver in base stations, antennas, and switching equipment. Now here's the problem. We're mining less silver every year. According to the Silver Institute, global silver mine production peaked in 2016 at 900 million ounces. By 2024, production had declined to approximately 830 million ounces. We're seeing a structural decline in output even as demand continues to accelerate. Why? 3 reasons. First, most silver isn't mined from dedicated silver mines. Roughly 70% of silver comes as a byproduct of mining other metals, copper, lead, zinc, gold. When those primary metals become unprofitable to mine, silver production drops regardless of silver's price. Second, the easiest, highest-grade silver deposits have already been mined. What's left requires deeper drilling, more processing, higher costs. The marginal cost of production is rising. Third, permitting new mines takes 7 to 10 years in most jurisdictions. Even if companies wanted to bring new supply online right now, they couldn't. The lead time is too long. Let's look at the supply-demand math. 2024 total demand was 1.2 billion ounces. 2024 mine production was 830 million ounces. That's a deficit of 370 million ounces. That deficit has to be filled from somewhere. Right now, it's coming from above-ground stockpiles, silver that was stored during previous surplus years, silver held by governments, silver in ETFs and investment accounts. But those stockpiles are finite. The Silver Institute estimates that identifiable above-ground silver inventories have declined by 40% since 2020. We're burning through the buffer, and when it runs out, the market will have to clear through price. Dramatic, violent price increases. Bank of America knows this. Their commodity research team has access to mine-by-mine production data, smelter reports, industrial order books. When they put out a $309 target, they're not guessing about supply constraints. They're seeing them in real-time data. Now we need to talk about the elephant in the room, paper silver. When most people buy silver exposure, they're not actually buying silver. They're buying contracts, ETFs, certificates, promises that silver exists somewhere in a vault backing their investment. The largest silver ETF in the world is SLV, the iShares Silver Trust. It claims to hold over 400 million ounces of physical silver. Investors treat it like physical metal because it's convenient. You can buy and sell it instantly. No storage costs, no premiums, no hassle. But here's the critical question. Is the silver really there? I'm not suggesting fraud. I'm pointing out a structural problem with the paper silver market that could trigger a crisis. Let's look at the COMEX, the Chicago Mercantile Exchange, where silver futures are traded. This is where the official price of silver is set through futures contracts. On any given day, the COMEX trades contracts representing billions of ounces of silver. But here's the reality. The COMEX has roughly 300 million ounces of registered silver available for delivery. Now do the math. If even 10% of the open interest, the total contracts outstanding, demanded physical delivery, the COMEX couldn't fulfill it. The exchange would default. The contracts would settle in cash, not metal. This isn't conspiracy theory. This is exchange math. You can verify these numbers yourself on the CME website. And this is exactly what Bank of America's strategists are modeling when they talk about a compression in the gold-silver ratio. They're anticipating a moment when the paper market loses credibility and investors demand physical metal. What happens then? Premiums explode. Right now, if you want to buy a 1-ounce silver coin from a dealer, you'll pay maybe $3 to $5 above spot price. That's the premium. But when physical demand overwhelms paper supply, those premiums can go to $10, $15, even $20 per ounce. We saw this in 2020 during the COVID panic. Silver spot price was $24, but you couldn't buy physical silver for less than $35. The disconnect lasted for months. Bank of America's forecast isn't just about the spot price on a screen, it's about what happens when the world realizes that there isn't enough physical silver to meet demand at current prices. There's another force driving this silver forecast that most Western analysts are overlooking: China. Let me give you the numbers that should terrify anyone betting against silver. China accounts for 60% of global solar panel production. They're manufacturing panels at a scale that seemed impossible just 5 years ago. The Chinese government has mandated aggressive solar deployment targets as part of their energy security strategy. Every one of those panels requires silver. But here's what's really important. China is not sourcing that silver from the COMEX or from London vaults. They're securing physical metal through direct deals with mining companies, strategic stockpiling, and domestic production. According to Chinese customs data, silver imports into China reached record levels in 2024. They're pulling physical metal out of the Western financial system, and it's not coming back. Why does this matter? Because when China removes silver from the global market, it creates a permanent supply reduction for everyone else. Western investors might see paper silver trading at $32 on their screens, but the physical market, the market where industrial users actually acquire metal, is becoming increasingly tight. And China isn't just buying silver for solar panels, they're also accumulating it as a strategic resource. Remember, China is the world's largest manufacturer of electronics, EVs, batteries, and 5G infrastructure. Silver is mission-critical to all of these industries. The Chinese government views silver the same way they view rare earth elements or semiconductors, as a strategic commodity that must be secured at any cost. Now let me connect this to Bank of America's forecast. When Bank of America's strategists model silver demand, they're looking at China's 5-year plans. They're analyzing production quotas, import licenses, stockpile data. They can see the trajectory. And the trajectory points to sustained, aggressive Chinese buying that will not stop regardless of price. This is why the $309 target isn't science fiction. It's a mathematical response to structural demand that cannot be denied. Let's talk about the monetary side of this equation, because silver isn't just an industrial commodity, it's also a monetary metal with a 5,000-year history as currency. And that history is about to become very relevant again. Here's the backdrop. Global debt levels are at all-time highs. The United States alone has $36 trillion in federal debt. Europe is drowning in sovereign debt. Japan's debt to GDP ratio exceeds 260%. These are unsustainable numbers. Central banks have two options: default or inflate. They always choose inflation. When central banks expand money supply, and they will because they have no choice, investors flee to hard assets: gold, real estate, commodities, anything that can't be printed. Silver fits perfectly into this flight to safety, but with a crucial advantage over gold: it's more affordable for retail investors. Think about it. A single ounce of gold costs nearly $3,000. That's out of reach for most people trying to protect their savings. But silver at $32, that's accessible. You can buy 10 ounces for $320. You can dollar cost average into a position over time. This affordability creates a powerful dynamic during inflationary periods. Retail investors pile into silver en masse, driving price momentum that attracts institutional capital, which drives further momentum, which attracts more retail. It's a reflexive cycle. We saw this in 1979 to 1980. We saw it in 2011. And Bank of America is positioning for it to happen again. But here's what makes this cycle different. Central banks themselves are buying precious metals at record levels. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2022, 2023, and 2024, 3 consecutive years of record buying. They're diversifying away from dollar-denominated assets. And while central banks focus on gold, their buying creates a spillover effect into silver. When gold rises, the gold-silver ratio compresses, and silver outperforms. It's a mechanical relationship that has held for centuries. If gold reaches Bank of America's 2026 target of $4,538, at current 90-to-1 ratio, silver equals $50. At historical 60-to-1 ratio, silver equals $75. At stressed 32-to-1 ratio, silver equals $141. At extreme 15-to-1 ratio, silver equals $302. Bank of America isn't predicting which scenario occurs. They're saying that any movement toward historical norms produces extraordinary silver returns. Let's look at the technical picture, because the chart is setting up for a major breakout. Silver just closed 2024 with a gain of over 140%, its best annual performance in decades. The metal broke through multiple resistance levels that had capped price for years. Here are the key technical levels. $30, the decade resistance. Silver struggled to break above $30 for most of the 2010s. That level is now support. Every dip toward $30 has been aggressively bought. $35, the 2011 support level. When silver crashed from $49 in 2011, it found support at $35 before eventually breaking lower. That level is the next major resistance. $50, the psychological barrier. This is the all-time high from 2011. Breaking $50 would trigger massive momentum buying from trend-following algorithms and retail FOMO. But here's what's really important from a technical perspective. Silver is forming a massive base. For the past decade, silver has been consolidating between $14 and $30. That's 10 years of building energy, 10 years of weak hands getting shaken out, 10 years of supply being absorbed. In technical analysis, the longer the base, the bigger the move when breakout occurs. Silver is coiled like a spring. And there's another technical factor that professional traders are watching, the commitment of traders' report. The COT report, published weekly by the CFTC, shows positioning of different market participants. For years, commercial traders, the banks and bullion dealers, have been net short silver, betting against it. But that positioning has been shifting. As of the most recent data, commercial short positions in silver have declined to multi-year lows. The smart money is no longer fighting silver's rise. They're positioning for it. When the institutions that traditionally suppress silver stop suppressing it, there's nothing left to hold price down. Now let me give you the other side of this story because I'm not here to sell you silver, I'm here to help you understand what's happening. Bank of America's $309 forecast is a long-term projection based on extreme historical ratios. It's not a prediction that silver hits $309 next month or even next year. Michael Widmer's analysis is based on the gold-silver ratio compressing to levels seen in 1980, a period of extraordinary monetary chaos, double-digit inflation, and geopolitical crisis. For silver to reach $309, we would need gold to remain elevated above $4,500 or continue rising, industrial demand to remain strong across solar, EV, and electronics sectors, paper market stress that drives investors toward physical metal, monetary instability that sends capital fleeing into hard assets, and supply constraints to persist or worsen. All of these factors are plausible. Some are already in motion, but they're not guaranteed. Here's what could go wrong. Global recession. If we enter a severe economic downturn, industrial demand for silver could collapse. Factories would shut down, solar installations would pause, EV production would slow. Silver price would suffer. Technological substitution. If scientists develop a viable alternative to silver in electronics or solar, demand could evaporate. This seems unlikely given silver's unique properties, but it's theoretically possible. Central bank pivot. If central banks somehow achieve a miraculous soft landing and inflation stabilizes without monetary chaos, the flight to precious metals might not materialize. COMEX expansion. The exchange could increase registered silver inventories by incentivizing deliveries, which would ease physical tightness. These are real risks. Any honest analysis must acknowledge them. But here's my assessment. The path toward significantly higher silver prices is more probable than the path toward lower prices. The supply deficit is real. Chinese demand is real. Monetary instability is real. The paper market vulnerabilities are real. Bank of America isn't guaranteeing $309. They're saying the mathematical framework exists for silver to reach those levels if conditions align. And conditions are aligning. Let's talk about practical implications. If you're watching this video, you're probably wondering, should I buy silver? I can't give you financial advice, I'm not your financial advisor, and silver is a volatile asset that can drop 30% in a matter of weeks. But I can tell you what informed investors are considering. Position sizing. If you believe in the silver thesis, the question isn't whether to own silver, it's how much. Most precious metals advisors suggest 5 to 10% of a portfolio in physical metals as insurance against monetary instability. Physical versus paper. Given the concerns about paper market stress, many investors prefer physical silver coins or bars over ETFs. Yes, premiums are higher. Yes, storage is required. But you eliminate counterparty risk. Dollar cost averaging. Silver is too volatile to time perfectly. Buying fixed dollar amounts monthly can smooth out volatility and reduce the risk of entering at a peak. Long-term horizon. Bank of America's analysis is based on multi-year trends. If you're buying silver because you think it'll double next month, you're gambling. If you're buying because you think the supply-demand fundamentals favor higher prices over 2 to 5 years, that's investing. Risk management. Never invest money you can't afford to lose. Silver can and will have violent corrections. In 2011, it dropped from $49 to $26 in a matter of months. Here's what I'm watching as signals that the Bank of America thesis is playing out. Silver breaking above $35 and holding, that's first confirmation. Gold-silver ratio dropping below 70, second confirmation. Physical premiums expanding beyond $8, third confirmation. ETF inflows accelerating, fourth confirmation. If all four signals trigger, the probability of a major silver rally increases substantially. Everything I've shown you today converges on a single point. The silver market is smaller than people realize, more critical than people understand, and more vulnerable to disruption than markets are pricing in. Bank of America's $309 forecast isn't hype. It's not designed to pump silver prices. It's a research note published for institutional clients managing billions of dollars, clients who need accurate information to make allocation decisions. When a bank like Bank of America puts out a target that extreme, they're telling their clients, prepare for significant volatility and potentially massive repricing in this market. The question isn't whether silver can reach $309. History proves it can. In 1980, adjusted for inflation, silver reached equivalent levels. The question is, are we entering a period similar to 1980? Massive government debt, monetary expansion, energy transitions, supply constraints, geopolitical tension. The parallels are striking. Two types of people will watch this video. The first group will dismiss it as precious metals propaganda and move on. The second group will recognize that something fundamental is shifting in commodity markets and will position accordingly. I can't tell you which group to be in, but I can tell you this. The window where silver is trading at $32 may not be open much longer. Whether it goes to $50, $100, or Bank of America's $309 target, the current price represents a market that hasn't yet priced in the full scope of coming supply-demand imbalances. The countdown has started. The math doesn't lie. And Bank of America just gave us the roadmap. What you do with that information is up to you. This has been the Silver Shock, Bank of America's $309 forecast. If this analysis helped you understand what's happening in precious metals markets, subscribe to the channel for more deep-dive financial documentaries. The next chapter of this story is just beginning. See you on the other side.